Hello and welcome back. This is part 2 in a 4-part series detailing the buckets, the why, and the how. In this video, we will be looking at bucket 2, which many people refer to as the income bucket. Now, in the last video, I mentioned that we typically put 6 months to 5 years of your need into bucket 1. Those familiar with the markets might know that in a recession, the stock market can take longer to recoup its losses than 6 months to 5 years. That's why bucket 2 doesn't put the pedal to the metal right away. The purpose of bucket 2 is to increase the risk enough to give you a better return, but still try to keep that volatility low. In many cases, bucket 2 will be a moderate to moderate conservative allocation and will often use stock in addition to asset classes we will discuss later. Let's take a look at the why. 1. Better inflation mitigation. Bucket 2 consists of investments that are still liquid, historically less volatile than the stock market, but it has a little extra added component to it. It is built to try and outpace inflation. This is an especially important component when inflation goes through the roof. Number 2, further stability. In subsequent buckets, stability is not going to be a defining principle. That's why it's especially important here. You need something to insulate you from the volatility of the stock market. Bucket 3 and 4, those are sometimes going to need a long time to bear fruit. And while we're waiting for those investments to potentially hit some home runs, we need bucket 2 putting players on base. Number 3, better income generation. Bucket 2 investments tend to have better income generating capabilities. This income can supplement your paycheck, making bucket 1 even stronger. Bucket 2 does a lot more than bucket 1, so let's take a look at the how. Again, this isn't a comprehensive list, but here are some of the highlights we tend to use to create a second bucket. 1. Core bonds. Bonds are an investment type where the investor lends money to a company, government, or bank and receives a promise to pay that money back plus some agreed upon interest rate. Core bonds refers to a bond issued by a highly respected organization, like the U.S. government or a well-funded private company. These obligations are often bound together in a mutual fund or ETF, providing you even greater diversity, income, and stability. Number 2, commodities. Think oil, corn crops, and orange juice futures. Commodities tend to be used as an inflation hedge because these investments are in a lot of the types of consumer products whose prices are also increasing. Number 3, preferred stock. An investment type that combines the income-producing benefits of a bond with the volatility that is more often seen in the stock market. The benefit here is that preferred stocks tend to pay a much higher rate of income than core bonds or other types of investment vehicles that we use in bucket 2. The income is still not guaranteed, but the preference referred to here in the preferred stock is the requirement to pay preferred stockholders before common stockholders. We're beginning to move into some more complicated investment types in bucket 2, but don't get tripped up. Just remember, we are looking for inflation mitigation, further stability, and income more than growth in this bucket. If you can remember that, we can take care of the rest. Coming up next, we have a video about the stock market bucket, bucket 3, so be sure to check that out.